Recently, several foreign companies have withdrawn from the Chinese market due to the deterioration of the business environment. U.S. technology giant Microsoft will close all offline authorized stores in China as of July 2024, retaining only the official website, Jingdong flagship store, and after-sales service locations. According to Microsoft's official website, there are currently 51 Microsoft stores in mainland China, most of which are Xbox and Sundan Microsoft Experience stores, and there are only 7 authorized retail outlets left. The media inquired about the several authorized Microsoft stores in Beijing and Liaoning and found that some of the stores have been closed over the past half a month, but some stores are still in normal operation. However, people in charge of those stores disclosed that they received a notification to close and were preparing to close the store. The public is also concerned about the news that Microsoft's Azure AI team in China is withdrawing from the Chinese market in batches and that team members will be packaged as different groups and transferred to the US, Australia, Ireland, and other places. According to the report, Microsoft has notified via email that the core team, including the Azure ML team and the AI platform, will be withdrawn from China, and the company will also be responsible for the visa issues of the employees' families. Some Microsoft employees disclosed that their team would move to Ireland as a whole, and they were asked to choose whether to transfer or not. Relevant sources at Microsoft told China Business News that the transfer is optional and will not affect the company's operations in China. According to sources familiar with the matter, the company asked for a decision on whether to accept the transfer offer by June 7, 2024. Those who are willing to relocate can bring their spouses and children, and the company will be responsible for their visas. Some believe that this is a layoff in disguise, because making such a big decision so quickly is a lot of pressure. Some employees aren't willing to leave China. Our group is not on this list. If there is such an opportunity in the future, I won't go abroad. I have considered several aspects. First, money. Our salary in China is relatively high. If we go abroad, our standard of living may not be able to maintain its present state, and our standard of living will likely go down. Second, there is the issue of visas. If you go to the US on an L1 visa, you can't change jobs and your salary will probably be restricted. If you are laid off, you can only go back to China. The future lottery for H-1B visas and green card status is full of uncertainties. Furthermore, the difference in cultural and educational background makes it difficult to integrate into the local society. Last, it's lonely to be out there with no relatives and friends. But many people envy Microsoft employees who have the opportunity to emigrate. If Microsoft packs up the Chinese talent and pulls out, China will not only lose the multinational company, but also its tech talent.
Microsoft's 400 AI team is rumored to be moving to 3 different countries. Some people think it's a conspiracy, but I don't think it's that complicated. It's just that by moving to other countries, these people will be better off in the future. After all, in China, there are a lot of rules and requirements that aren't easy for research and development people. But it's still a big loss for us if they move out. After all, these 400 people were originally working in China and are Chinese. If they do well at Microsoft and when they leave one day for another company, it would be a good thing for us. But now these people have moved out. It's really a loss for us.
Amazon Kindle e-bookstore also completely withdrew from the Chinese market at the end of June, stopping the cloud download service. Kindle no longer provides customer service either. In addition, Lonely Planet, a leading travel guide, announced that it is closing its China office, ceasing its publishing business in China, stopping updating all of its official social media accounts, and ceasing to publish Chinese language guides. Meanwhile, Japan's Mitsukoshi Isetan has closed its 27-year-old department store in Shanghai, keeping only one store in Tianjin. A few days before that, Isetan Department Store Shanghai put up a farewell poster at the entrance of the mall. Thank you signs were displayed everywhere in the building, and various departments were offering discounts of between 20 and 50%, attracting a lot of customers. This is a scene filmed by an Edison. On June 30th at 1800, Isetan Shanghai officially closed its store, and the management came to see off the guests. In recent years, China's department store industry has ushered in a wave of store closures. Many department stores that once thrived in major cities in mainland China and gained a good reputation, such as Pacific Department Store, Aeon, Parkson, Jiabai, Grand Ocean Group, and New World Department Store, have successively closed their doors, ceased operations, and withdrawn from the Chinese market. Statistics from the Retail Research Center of the United Business Network show that in 2023 alone, 21 well-known department stores in China announced that they would close their stores and cease operations. This reflects the fact that China's department store industry is entering a period of gradual shrinkage and depression. Against the backdrop of China's continuing economic downturn, foreign automakers have also been hit hard. In fact, sales of Japanese cars have dropped by 20% from their peak in 2020 due to the low-priced offensive by Chinese automakers. Foreign car companies are facing a crisis, and their sales volume has dropped seriously. The Changzhou plant, a joint venture between Nissan and Dongfeng, closed on June 21, 2024. This is the first time that Nissan has closed a passenger car plant in China, and the public is worried that many workers will become jobless. It's reported that the Changzhou plant has an annual production capacity of 130,000 vehicles, accounting for about 10% of the total production capacity in China, and was previously responsible for assembling SUV models. At the presentation of the midterm business plan, Nissan's president talked about the severe situation in the Chinese market and said that the sales price in the Chinese market fell 2 years earlier than expected. U.S. law firm Dechert is considering closing its offices in Hong Kong and China due to the continued downturn in capital markets and growing tensions between China and the U.S., becoming another multinational law firm to reduce or close its business in the Greater China area. Unnamed sources told Reuters that Dechert notified staff earlier this month that it may close its Greater China operations and move to its Singapore office. In March 2024, due to the downturn in Hong Kong's capital markets, Dechert had already disbanded its entire corporate IPO team. In recent years, as Beijing continues to strengthen social control through new legislation, foreign companies have become increasingly worried about the uncertainty of the Chinese market. Leaving China has become a new trend. In addition to Dechert, law firm Morrison Forrester also announced that it will reduce its business in Beijing. Sidley Austin closed its Shanghai office in May and said it would move employees to Beijing and Hong Kong by September. At the same time, the American consulting firm Bain announced that it would cease some business in China. Its new CEO said the company will no longer provide consulting services for certain sensitive industries in China as tensions between the U.S. and China intensify, and Beijing intensifies scrutiny of Western companies operating in China. This series of withdrawals by foreign companies reflects the uncertainty of China's economic environment and the tremendous pressure that foreign companies face when operating in China. In April 2023, Beijing issued a new anti-espionage law, which extends the definition of state secrets and intelligence to any documents, data, information, or articles related to national security and interests. Soon after, Beijing police raided Bain's offices in Shanghai, questioning employees and confiscating computers and cell phones. This followed a raid on the Beijing office of Mintz Group, a U.S. corporate research firm, in which 5 local employees were detained. Capvision also suffered a similar raid. Nikkei News reported that a year after the newly revised anti-espionage law came into effect, the Beijing authorities' National Security Department has been given more power since July 1, 2024. It has expanded the scope of information related to national security and interests, allowing the department to inspect luggage and electronic equipment on suspicion of espionage. The operating guidelines state that authorities can check cell phones and personal computers by presenting a police ID card or other proof of identity. Foreigners are concerned that they will be subjected to such stringent checks when entering and residing in China. The implementation of Beijing's new anti-espionage law has led to the closure of several multinational law firms in China, including Perkins, Coie, Latham & Watkins, and Orrick. For much of the same reasons as other international firms, Taiwanese firms are also pulling out. The Taiwanese business community is now shifting investments, trade, and purchases from China to Southeast and South Asia, with some Taiwanese investments going to the U.S. Although mainland China remains Taiwan's largest trading partner, its share of Taiwan's trade has been steadily declining since 2021. In 2021, China-Taiwan trade was $208.4 billion, about a quarter of Taiwan's total external trade. By 2023, this figure dropped by nearly 20%. In comparison, Taiwan's total trade with Southeast Asia grew by nearly 10% in the year from 2021 to 2022. Taiwan's export dependence on China has also decreased, reaching its lowest level since 2018. Pingtong Island in Fujian Province is the closest place on the mainland to Taiwan Island. To attract Taiwanese investment, the island has always offered tax breaks, subsidies, and residency assistance to Taiwanese investors. However, there are now very few Taiwanese on the island. Last year, Taiwan's investment in Fujian fell 80% year-on-year to $220 million, a 22-year low. Trade has also been affected. In 2023, Fujian's imports from Taiwan fell 10.2%, while exports dropped 15.6%. As China's economy weakens, it now faces losing decades of investment and support from Taiwanese businessmen, making Beijing's stance on Taiwan even more embarrassing. Forbes published an article saying that the more Taiwan's trade and investment in Southeast Asia and South Asia grow, the greater the interest of Asian countries in Taiwan, and the more likely they are to resist any sabotage by the Beijing authorities. Of course, these countries generally will not use military force to stop the CCP's threats to Taiwan. However, other actions will also make its stance toward Taiwan more embarrassing. What's noteworthy is that more and more foreign investors are now withdrawing from the Chinese stock market, causing the 4 consecutive months of capital inflows to almost stop. As of June 26, global funds sold approximately $6.8 billion in Chinese stocks through the Hong Kong Stock Exchange in June. Bloomberg reported that capital outflows caused the stock market to fall, with the MSCI China Index falling into correction territory. The CSI 300 index of domestic stocks have fallen more than 6% since its mid-May high. Earlier this year, foreign investors also bet that Beijing would take more measures to support the economy, driving up the Chinese stock market. However, after the third plenary session of the Beijing authorities came to an end, foreign investors failed to see the effective measures taken by the Beijing authorities, and the glimmer of hope was lost. As a result, the stock market began to plummet. As of March 2024, the world's largest hedge fund, Bridgewater Associates, managed more than US $171 billion in assets. But Bridgewater Associates has also been selling off Chinese stocks in recent months, joining a global retreat among investors. Bridgewater Associates founder Ray Dalio recently said in an exclusive interview with Nikkei Asia that the real estate debt problem is seriously dragging down the Chinese economy. Debt has been swelling since China's economic boom in the 1980s, widening the gap between rich and poor, and coupled with population decline caused by childbirth policies, the national debt has also increased. Dalio believes that China needs to restructure its debt, but this process will be extremely painful and difficult. In addition, under internal and external pressure on the Chinese economy, the number of IPOs has dropped sharply and the logistics short position rate has increased. Market uncertainty and the operating pressure faced by enterprises are increasing. The New York Times Chinese website reported that Chinese internet companies once led the IPO trend on Wall Street, but in the past 3 years, this phenomenon no longer exists. Chinese companies have raised only about $580 million on the US stock market so far this year, most of which came from electric car maker Zeekr's IPO last month. The situation for domestic IPOs in China is equally bleak. The report pointed out that as Chinese regulators have made listing more difficult, the listing speed of domestic companies has slowed down significantly. So far this year, about 40 Chinese companies have gone public domestically, raising a total of less than US $3 billion. If this trend continues, the number of IPOs in China this year will be the lowest in more than a decade. In addition, the average vacancy rate of logistics warehousing in eastern and northern China is close to 20%, the highest level in recent years. Still, more warehouses continue to be built locally, further exacerbating the problem. This is because Chinese consumers are becoming increasingly frugal, e-commerce growth is slowing, and geopolitical tensions have prompted companies to move some production lines offshore to reduce their dependence on China. These factors, coupled with declining foreign trade, have led to declining demand for warehousing facilities from Chinese companies. The report also pointed out that warehousing rents in many cities in China are also falling. According to data from U.S. real estate consulting firm Cushman & Wakefield, 13 of China's 20 major cities saw warehouse rents fall in the first quarter of 2024 compared with the previous quarter, with Beijing and Shenzhen seeing the most significant declines at 4.2% and 3.9% respectively.